Today we will talk about how to invest money like the rich. Hey, guys, welcome to our channel Millionaire Mindset, a place where you can get knowledge to build your wealth and grow your business. Almost everyone should own stocks. That's because stocks have consistently proven to be the best way for the average person to build wealth over the long term. US stocks have delivered better returns than bonds, savings accounts, precious metals, and most other investment types over the past 4 decades. Stocks have outperformed most investment classes over almost every 10-year period in the past century and have averaged annual returns of 9%, 10% over long periods of time. To put returns like this into perspective, a $10,000 investment compounded at 10% for 30 years would grow to nearly $175,000. Why have US stocks been such great investments? Because as a stockholder, you own a business. And as that business gets bigger and more profitable, and as the economy grows, you own a business that becomes more valuable. As legendary investor Warren Buffett puts it, investing in US stocks is a bet on American business, and this has been an excellent bet for more than 2 centuries. We can use the past 20 years as an example. Even across 3 of the most brutal stock market declines in history, the stock market has delivered better returns than gold or bonds. Consider the benchmark S&P 500 index, widely considered to be the best barometer of how large US stocks are performing. Over the past 2 decades, the S&P 500 has delivered 540% total returns, which includes stock price gains as well as dividends. In other words, a $10,000 investment would have turned into $64,000, and that's including the effects of the 2008 financial crisis, the COVID-19 crash in 2020, and the bear market downturn of 2022. Stocks are not risk-free investments by any definition. Even the most stable companies' stocks can fluctuate dramatically over short periods of time. Looking back at the past 50 years, the S&P 500 has declined by as much as 37% in a single year and has risen by as much as 38%. Because of their tremendous wealth building potential, stocks should make up the foundation for most people's portfolios. What varies from one person to the next is how much stock makes sense. For example, someone in their 30s saving for retirement can ride out many decades of market volatility and should own almost entirely stocks. Someone in their 70s should own some stocks for growth. The average 70-something American will live into their 80s, but they should protect assets they'll need in the future by investing in bonds and holding cash. There are 2 main risks with stocks. Volatility. Stock prices can swing broadly over very short periods. This creates risk if you need to sell your stocks in a short period of time. Permanent losses. Stockholders are business owners, and sometimes businesses fail. This risk can be mitigated by focusing on established and stable businesses and by creating a diversified portfolio of stocks or choosing to invest in exchange-traded funds, ETFs, or mutual funds. Managing volatility. If you have a kid heading off to college in a year or 2, or if you're retiring in a few years, your goal should no longer be maximizing growth. It should be protecting your capital instead. It's time to shift the money you'll need in the next several years out of stocks and into bonds and cash. If your goals are still years in the future, you can hedge against volatility by doing nothing. Even though some of the worst markets crashes in history, stocks have delivered incredible returns for investors who bought and held. Avoiding permanent losses. The best way to avoid permanent losses is to own a diversified portfolio, without too much of your wealth concentrated in any one company, industry, or market. Diversification will help limit your losses to a few bad stock picks, while your best winners will more than make up for their losses. Think about it this way: if you invest the same amount in 20 stocks and one goes bankrupt, the most you can lose is 5% of your capital. Now let's say one of those stocks goes up 2,000% in value. It makes up for not just that one loser but would double the value of your entire portfolio. Diversification can protect you from permanent losses and give you exposure to more wealth-building stocks. Another effective way to avoid permanent losses is to invest, either exclusively or partially, in ETFs and/or mutual funds. For example, if you invest in an S&P 500 index fund, your money will be spread out among the 500 companies that make up the index, and therefore it wouldn't be devastating if any one of them were to fail. To be perfectly clear, every investor is different. there's no rule of thumb that works for everyone. Having said that, one popular asset allocation guideline used by financial planners is to subtract your age from 110 to determine the approximate percentage of your portfolio that should be in stocks. For example, according to this rule, 40-year-olds should have roughly 70% of their money invested in stocks. Invest in bonds. In the previous example, you might be wondering where the other 30% of this hypothetical investor's money should go. And the general answer is that it should be in stable, income-producing assets, with bonds, or fixed income securities, being the main category. Over the long term, growing wealth is the most important step. But once you've built that wealth and gotten closer to your financial goal, bonds, which are loans to a company or government, can help you keep it. There are three main kinds of bonds. Corporate bonds, issued by companies. Municipal bonds are issued by state and local governments. Treasury notes, bonds, and bills, issued by the U.S. government. Here is a recent example of how bonds can be useful investments, using the Vanguard Total Bond Market ETF, NISMKIT, BND, which owns short and long-term bonds. And the iShares 1 to 3-year Treasury Bond ETF, NISMKIT, SHI, which owns the most stable Treasury bonds, compared to the S&P 500. This chart is from February through April 2020, when the COVID-19 pandemic sent financial markets into a panic. As the chart shows, while stocks were crashing hard and fast, bonds held up much better, because a bond's worth, the face value, plus interest promised, is easy to calculate and far less volatile. As you get closer to your financial goals, owning bonds that match up with your timeline will protect assets you'll be counting on in the short term. Invest in real estate. Just like owning great companies, owning real estate can be a wonderful way to build wealth. In most recessionary periods throughout history, commercial real estate has been countercyclical to recessions. It's often viewed as a safer, more stable investment than stocks. There are ways for people at almost every financial level to invest in and make money from real estate. The most obvious is buying a rental property, which can be a great way to build wealth and create an income stream, but it isn't the best fit for everyone. Fortunately, there are alternative ways to invest in real estate, many of which are much more passive than actually becoming a landlord. Publicly traded REITs, or real estate investment trusts, are the most accessible way to invest in real estate. REITs trade on stock market exchanges just like other public companies. Here are some examples. American Tower, NYSE, AMT, owns and manages communications sites, primarily cell phone towers. Public Storage, NYSE, PSA, owns almost 3,000 self-storage properties in the US and Europe. Avalon Bay Communities, NYSE, AVB, is one of the largest apartment and multifamily residential property owners in the US. REITs are excellent investments for income since they don't pay corporate taxes, as long as they pay out at least 90% of net income in dividends. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thank you for watching.